Hello, everyone. Welcome to the market update for Tuesday, March the 2nd. I appreciate everyone being with me last week. I wasn't able to do the live class. I was able to get the recordings done. Was on a vacation, and so I just had to kind of work it around my schedule. But hopefully you learned some things. Some of the trainings we did were good. We wrapped up the Elliott Wave class. And the training today, after we do the market update, we're going to get into options, learning about options. Most of today will be just some, going through some terminology that we need to learn. I'll give you an example of how an option works, and just real introductory stuff today. And I'm approaching the training from the standpoint of someone that knows nothing about options and is getting started for the very first time. So if you have some experience with trading options, you understand them, you're probably not going to want to stick around through this training. It's already stuff you probably understand and know, and would be probably a waste of your time. But I do know that there's a lot of people that are getting interested in options, especially in this market environment, and so I'm going to kind of go through it just step by step over the next couple weeks or so, and we're going to learn how to take advantage of it. Actually, it might be more than a couple weeks, because we're going to learn how to be option buyers at first, and then we'll talk about how we can be option sellers and what are the advantages of being an option seller. We'll get into that later, which is a little bit more complex. All right, let's get started with the market update, though. There's something that we need to pay attention to here. We don't really go over it very often because it doesn't happen very often, but whenever you get the sentiment, which is the blue line right here, let me change my pen color. Whenever you get the sentiment, which is the blue line right there, and if you can't remember, right down here it'll say sentiment. When sentiment is above momentum, which is the red line, and the red and green lines are right at each other, right in the same spot there, basically. But whenever you get sentiment above momentum and momentum above breadth, and breadth is the green line, it indicates that you're dealing with a tired market. And we can definitely see that. This is something I've talked about last week, that the market is looking like it's kind of stalling. And I talked about how the Qqq chart looks broken. We're going to look at that chart here in a minute. I don't think the Qqq is going to see, or the NASDAQ 100 is going to see all-time highs for a while. I think there's a lot more downside ahead for that index before I expect it to rally. One of the things, now again, this can all change. Again, I'm not trying to say that to be some sort of market psychic thing. I've done this long enough to know that you can't know exactly what the market's going to do. There can be news that comes out, or something that comes out that gets buyers excited again. They come charging back in the market, and they push things up. That could always happen, and you have to be prepared for that to happen if it does, to go along with the trend. That's trend traders. We're not trying to be psychics or predict. We're trying to follow, and the dynamics could definitely change. The Fed could do something that, the Fed could do something right now that either makes the market excited or it freaks it out. That's how sensitive things are right now, that it could go either way. But the way it's acting right now, it's acting sluggish, and it's acting like it's having trouble going higher. And you can almost kind of feel it, that the buying energy just isn't there, especially if you've been watching the market over the last few months. I mean, November, man, that buying energy was incredible. It didn't matter what you bought. The market just kept going higher and higher and higher. We did get these sell-offs, but they were brief, and then we go roaring right back. And I've talked about how, again, we'll look at these index charts here in just a second, but I've talked about how as we've been going to these new highs, that once we break out to a new high, the market should take off, but it isn't. It's kind of moving sideways, and we almost need a big sell-off to bring prices down, bring valuations down, and get buyers excited again. Now, we don't want that sell-off to create so much fear that people are afraid to buy. to where we have a really big correction, a really big downward move. But you need these healthy moves, and they need to be more than just a few days. They need to usually be a couple weeks or so, that can bring things down to a level that buyers can get excited about and come charging back in. And so this indicator right now is showing what I've been talking about, how I felt for the last couple of weeks, which is this market is feeling kind of sluggish and tired. And so we'll see how that plays out. By the way, when you have breadth, when you have the green line right here at the top, and you have momentum, which is the red line in the mid. So breadth is above momentum, and momentum is above sentiment, which is the blue line. It usually means you have an energetic market, and a market that's, you have energetic buyers usually in that kind of situation. So if we do see that develop, I'll hopefully I'll notice it to point it out, and we can expect maybe a stronger trend at that point. Momentum is back in the hold range here off the sell-off late last week. It's actually moved up a little bit from the rally from yesterday. The breadth is kind of in the middle and trending. So we're definitely not in an overbought condition, and that's the thing that can make it difficult, is that we're not in an extreme overbought condition to where we can't go higher. It's just with valuations the way they are in many of these stocks, and like I said, it just feels like, and that's why I don't think we have a big correction coming. If we were really overbought and we're in some of these extreme levels, and we're getting some strong reversal signals, and then I feel like we have maybe a little bit bigger correction about to start in that situation. Sentiment is in the complacency range, which is getting the high range, but isn't extreme yet. We look at the buy-sell ratios. They came all the way together with the selling from last week, and then they started to move away again. Buys exceeding the sells, new buys with the move yesterday. And with yesterday's move, I wasn't expecting the volume to be as high as the sell-off days from last week, Thursday and Friday. But I did want to see follow through to that today. I wanted to see a stronger follow through, and the market's rebounded, and so we might, at least the Dow's rebounded a little bit. Nasdaq's still down, and S&P's down, but it still could maybe happen today. But I wanted to see it follow through in a little bit stronger way, which it doesn't look like it's going to do. Sentiment is off the high, so we're not dealing with, again, extreme overbought market or anything like that. Let's take a look at the individual charts. And like I said, the key one to me is going to be when we look at the Nasdaq, because if the S&P chart, technically, I don't see it as being broken. We haven't gone to a lower low yet. We had a higher high. If this is a ABC pullback, a bullish ABC pattern, and we're going to charge higher there, which is definitely a possibility, then this might recover. I think what's going to be key is going to be that Friday low. I thought if we broke below the low from, I think this was last Wednesday, or is that Wednesday? Let's see, that was Friday, Thursday, Tuesday. The Tuesday low, I thought if the market broke below that, it'd be in trouble, and it did break below it, but it ended up closing right at that low, and then rallied off of it this week so far. But I think this area right here is going to be critical. If we break that area, the next stopping point is all the way down here, and I pointed that out a number of times. Many of you are already aware of that. You probably already have it marked on your charts. And that would be good. I think that'd be good to get down into this area here. It'd be a decent pullback, but not one that's too far. It'd be similar to this one in October where we had. This is what I talked about in November. We had that nice rally in November, and it came after that pullback. Here was a deeper pullback right here that had a nice rally off of it. But notice again, when we started to go off of the pullback, we were having consecutive days we were going higher. That's why I'm worried about this sluggish move today. You worry a little bit that maybe this is the first move down, and this might be a bearish ABC pattern with A, wave B, wave C. And we're heading lower to that area there. So now I'm not seeing a lot of fear in the VIX yet, but one thing that could happen is that VIX could spike pretty quick, as we saw last week, and so if we do have a move down where we break these lows, the Tuesday low from last week, we're going to really see that VIX spike up quite a bit. So we'll keep an eye on that. And like I said, we'll know a little bit more by Thursday how we're doing from this area here and how things are kind of playing out. I think if we move above the Wednesday high right here, I think it's much more likely we're going to break out. Obviously, you could say, yeah, we're almost broken out at that point anyway. But I would anticipate, even if we ran up to here and pull back a little bit, that we'd end up breaking out. But it might be just a short breakout like we had right here. Here we only had a couple of days where we broke out. Here we barely broke out. We had an up day, and then we moved sideways. Remember I talked about how we were moving sideways for that long period of time, that week and a half. If we do break out, I would expect to see something similar, because that's something you would expect in a tired market, is to just be sluggish like that. Okay, but I do want to still point out that we haven't broken the trend yet in the S&P. The uptrend line, well, way back down to that low down there, but it's still kind of intact. Still having higher lows, higher highs. Dow chart's not much different, so I'm not going to spend too much time on that. The Dow chart did break out to a new high, though. It was the last one to kind of break out to a new high right there, but then look how it reversed it. Now, that concerns me as well, because remember when I taught the stair step, and when you're in an uptrend, looks like you're going up a set of stairs. And I said when you're dealing with the trend reversal, usually what you end up having is impulsive moves in opposite direction. You get an impulsive move up, followed by an impulsive move down, and then that often starts to trigger the stair step to the downside. Okay. So when you're pulling back off of a high, you don't want to see a sharp move down. You want to see something like this, where you're pulling back off of a high, but it's more choppy, more sideways. That's a corrective type behavior, and that usually leads to a continuation of the trend. Well, what we had here is we had impulsive up, we had a consolidation through here, and then you had impulsive up, impulsive down, and not only on that impulsive down, you also went to a lower low. Now this was a very mild low. It wouldn't be as significant as that low right there. So to say that this trend is broken, I wouldn't say it's broken yet, because I can still draw a horizontal, or not a horizontal, but a trend line up through here, and it hasn't broken that trend. You could say it's gone to a lower low there, and that also coincided with this high right here. So it has broken a support area, but this would be the key low that would really indicate that the trend is broken. Okay, because not only would it go to a lower low, a solid lower low, but it would also clearly break that uptrend line right there. Now you can make the argument that it could break below that uptrend line and be considered the trend broken, but I mean it would really be broken if it dropped below that low as well. But that definitely would be a sign that it's breaking down, as if it breaks that trend line. Now we did rally off of that, We are holding that, but that low from Friday is going to be key for the Dow chart. And again, just these are subtle things that I've been teaching over the last several weeks that you look for. You look for that impulsive up, impulsive down. This pullback wasn't real choppy or sideways. Now we have rebounded from it, but that was a pretty sharp drop right there. And you have to wonder, is this a drop? And if we're kind of stagnant right here, is that kind of your sideways choppy move, and then you're heading lower again? But if we do start to get up closer to these highs again, less likely that that's a corrective move. But that's why I want this thing. I'd want the market to be up today and have a strong move today, so it's clearly moving higher. Okay. And then let's look at the Qqq chart. And this one's broken. If I draw the uptrend line right through here, I draw the horizontal support right here. We broke the uptrend line last week, and then Thursday we broke the horizontal trend, went to a lower low. It's a slightly lower low, but when you combine that with breaking the uptrend line, this thing looks broken. It's so even if the other indexes break out and go higher, and the NASDAQ would probably go up with it, but I don't see the NASDAQ breaking above this high. And again, look at the behavior here. You have impulsive up, you have impulsive down, and then what's been happening since that impulsive move down? It's been more kind of back and forth, choppy. That behavior increases the probability that at some point we're heading lower. Again, we could still attempt to rally up. If it rallies up a little bit higher, it actually form almost a perfect bearish head and shoulders pattern. And usually the right and left shoulders are usually ending in about the same spot. So if we do rally a little bit higher, that would be a spot right up in here where I could see the NASDAQ being done, NASDAQ 100 being done rallying. This would be your neckline then. The bottom line, though, this is key right here, though, is if we break that, and we know about how far it should drop too, with if it does end up being a head and shoulders pattern, it could drop right here and still be a head and shoulders pattern. It's just, again, a lot of times those right and left shoulders will terminate about the same spot. But remember what we talked about, the inverse head and shoulders pattern. You take the distance from the bottom of the head to the top, or to the neckline, and then project that upward. Well, it would be the opposite here. You take the top of the head to the neckline, you project that downward, and then as soon as I kind of get that area there, I start looking for, is there support or resistance in that area there? You got a little bit of support right into here, a little bit of support resistance right into here. So that would be maybe a little bit shorter drop. A pretty big one down here. That'd be a bit bigger drop. That'd be a really big drop. But this is probably the area then that you target. If it did drop down into that area right there, it also, if this was a larger ABC that's being created here in a corrective move, that would be about the spot where wave C would be about the same length as wave A. We talked about that. I think we talked about that in the training on Thursday or Tuesday or Thursday. We talked about that. And I think I talked about that when I taught the ABC pattern several weeks ago too. So this 295, 296 area would be kind of the target spot for a correction to get down to. If it's just a correction of the larger trend and we're going to keep going higher, there's always possibilities it could break down even further than that. Now, like I mentioned at the beginning of the update, you never know when news comes out and the market gets excited again and the buyers get excited again, it just takes off. But again, this is more sluggish behavior. This is not showing strong buying. And like I said, with volume, I was hoping that I wasn't expecting volume to be as high as it was on Thursday and Friday. But yesterday, I wanted volume to at least be the same as or close to that Tuesday reversal. And it wasn't even. It was about half that volume from that Tuesday reversal. It didn't even get above the Wednesday rally from last week. So, and now we're the volume is a little bit sluggish again today. We'll see what happens here. All right, let's keep going down the list here. On the IWM, again, it hasn't really broken its trend yet either. It's kind of trying to hold on to that breakout right there. But, these lows are going to be important again. This low is going to be important. And this index is going to be important. I'm not going to spend a lot of time on it today, but remember, this has been the leadership of the rally, of the small caps. And so if this starts to really break down, then I'd be really, really concerned. And it's kind of lagged. It's showing it's kind of lagged. Can't seem to break out above this area right here. We'll see how that holds. We'll know more on Thursday how that's looking. Well, at least we should. All right. Bonds. Let's take the volume bars off here for a little bit because the volume bars will get in the way here. Last week I told you how we were in that extreme reversal risk and on the TLT. We're all the way to the left side. Well, we've alleviated that a little bit. We're still in the downtrend. I'm still assuming that bonds are going to continue to drop. We had that big spike up move on Friday, and then we've kind of rolled over a little bit since then. Now, again, it could still bounce around sideways through here for a little bit, but overall, I would expect that this is going to continue to move lower. I was kind of interested to see if this is a trend reversal because you had impulsive down and that looked impulsive up on Friday, but it quickly came back down. And usually you want to build on that to have a clear impulsive move. So it's putting a little bit of a question mark in. Now, like I said, that could just be wave A, and this is wave B, and you get wave C of a bearish ABC pattern, and then you continue lower. That would make a lot of sense. You saw that a little bit right through here, kind of a bearish ABC, and then it dropped again. If we do go lower, then this is going to be an important high right here, because if it could break above that, that would be a higher high. All right, let's go move on to gold. Gold, I said, is still in the downtrend, and it seems kind of counterintuitive because usually gold does really well in an inflationary environment. Well, we don't have we have mild inflation showing up, but the way the bond market reacted last week was the anticipation that we're going to start seeing inflation. Now, you might argue that, well, wouldn't that be what you trade with gold, is the anticipation that we're going to see inflation? And typically gold does well in an inflationary environment. Yeah, but that's not what the trend is showing you yet. And so, and I'm not a commodities trader, so I can't give you all the ins and outs of what moves gold and what I look for to move gold. I know a few of the basics that are pretty common. Usually a weaker dollar is bullish for commodities in general, and then, like I said, inflation is usually a bullish for gold and silver, but it's clearly in a downtrend. It's pausing a little bit right here, moving sideways, but it's not showing me that impulsive move, impulsive up, impulsive move down, impulsive up. That would indicate a trend reversal like we saw right here, impulsive down, impulsive up, and then look at the first pullback. It was more choppy, more sideways right through here. Had another impulsive move to a higher high, pulled back, more choppy and sideways. Impulsive move down, and then choppy and sideways. Impulsive move down. Here, this was a tricky one here because it had impulsive down, impulsive up. That's why it's not perfect. If it could perfectly predict it, we'd all be geniuses. But that's what fakes us. Almost every trader out once in a while is when it does something like this, where it looks like it could be reversing. Now, that'd be the early side of reversing trend, and then you still would want to see it go to that higher high. So this is going to be a key spot right here. This is the previous lower high right here. If you start to see gold moving up sharply and it looks more impulsive and it breaks to a higher high right there, those are two clues that you're probably dealing with the trend reversal. You also want to see that first pullback. Is it more choppy, more sideways? there's a good chance it's taken off, and you could take advantage of that. We'll see it. If I see it in the updates, I'll point it out. That it looks like it's a reversing trend. I know some of you are wanting to get into gold, but it's not saying to get in right now. Oil, been in an uptrend. What kind of jumps out here? Well, you pulled back, but notice how we pulled back. It was a sharp pullback. Could it be that we have impulsive up, impulsive down? Could be. We look like we're starting to get maybe impulsive move down right here and reversed it. So we probably need to wait a little bit on this to see how it plays out. It could be that this is just wave A, and then you get a little bit of a choppy couple days here, wave B, and then you get wave C. It's due to get a little bit of a pullback. This low is not a real solid lower low if it dips below that, because it only was a one-day drop. Well, it was a bearish reversal day here and then a one-day drop and then it resumed it. This low would be more important for a trend reversal, which is pretty far away. But it's still, oil's in an uptrend. And so I don't see any signs of it yet of reversing that uptrend. But we'll keep an eye on that price behavior there, see if that gives us a stronger clue over the next couple of weeks or so. The dollar looked like it was trending back down right through here, and then we had the spike back up here for a 3-day rally, Thursday, Friday, and Monday. It's reversed a little bit right here. So, you know, I would say this is looking a little bit more bullish here, just because you had lower high right here, lower low, and then you did on yesterday's move, you did go to a slightly higher high right there, and this does look like an impulsive move up, a little bit of an impulsive move down, impulsive move up. So this is kind of a critical area here. Now, I wouldn't be saying I'm really bullish on it yet, because you could make the argument that it's a head and shoulders pattern, and that you know, it's going to come back down. But so this is going to be a critical spot. If we start moving up solidly above this area right there, I'm going to be a little bit more bullish on the dollar if that happens. And if that does happen as well, if it would, you got a higher high, and especially when you get above this high right here, you'd have a higher high, and this would be putting in a higher low, a larger higher low right there. But it has a lot of head fakes. This has had a lot of head fakes the last few weeks, so we're not going to say there's a strong trend there. It's basically sideways trend still. But those are the clues that I'd be looking for to see where that direction is next. And then the VIX. VIX has come back down again, but we saw how quickly that spiked up last week. And we'll see if that happens here. There's really no reason for it to yet. The market is down a little bit today, but on really no big news that's out there. But so there's no really early warning. I'm just going off of just the look of the trend, saying that, hey, I don't, and the fact that Q's broke that trend, that I'm saying that we're in danger here of a little bit of a correction taking place here. All right, real quickly, let's go to a couple of stocks. Now, I wouldn't be getting into a ton today, but a lot of these would need confirmation anyway, so I think you're okay. I still like Overstock. We've gone over that one a few times. I like Big Five. It's a 96 strength rank. Let's switch the signals back on here. But I like this little pullback right into here. It still looks like a little concerned with the trend line. I mean, it's a critical spot, but I can still draw a trend line connecting the lows. And you're still okay. It's just if you were to connect these lows right through here, well, you're right on it. And I know that's not a straight line, but it's pretty close right there. But you're waiting for confirmation anyway. Waiting for go back to a buy signal. Then the computer and technology, I like this MVIS. It's a 100 strength rank, but it's showing a nice correction, a nice pullback. And this really sharp move up right here. This looks like maybe wave A, wave B, wave C. Has a bearish reversal day today, though, so that's something to keep an eye on. It might not be done correcting. It still could have further to drop. But, you know, if you go all the way back to the retracements class, you know, stocks will tend to retrace about 50% of their moves. Well, that would be the area where it found support, was about 50% of that rally right there. So that'd be the area where you would expect it to pull back to, and so far it's looking like it did. I just don't like that. It gapped up today and it's trading lower. It's at the lows of the day. That's kind of a bearish reversal day right there. But I've seen stocks reverse bearish reversal days, especially in this bull market, recent bull market. All right, another in computer and technology. We've already gone over this one before. IZEA. Gone over this a number of times. Still waiting for it to kind of take off and go. It did briefly go to a sell signal on Friday, so it's a little ways away from going back to a buy. But if it can rally up to a buy signal, I'd like that trend. And one more in computer and technology here. The CPSH has a 98 strength rank. Now this one could be in a C leg. Kind of similar when we first saw IZEA, where it felt it could drop a little bit further. This could be wave A, wave B, and we're in wave C. It could bring it down a little bit further. But I thought this is one we can kind of keep an eye on. But I would expect that to maybe pull back a little bit further. And this doesn't have a real high strength rank, but it's, you know, one thing I've seen, and this is something you see when you get into a tired market as well, is you see a lot of the defensive stocks start to rally. You're seeing Coca-Cola rally, and if you go under the autos sector here, you have GM and Ford that are rallying. GM right here, I like the Ford is getting a little bit overbought. We can look at the Ford chart here, but GM has had a nice day today, but you can see it have a little bit of a consolidation through here. This could be wave A, wave B, wave C, kind of a sideways correction here. You could even, just to be on the safe side, wait to see if it breaks out. But Ford is broken out, which is why, you know, GM might not be too far behind it. But it's a 71 strength rank. So I just want to point this out because if you're, you know, we're seeing some of the defensive stocks start to move. This would be maybe a defensive stock, but you can see on Ford it has broken out. It broke out back here, and then it broke out to another high today, but it's starting to get into that extreme reversal risk range, so you have to worry about that a little bit. All right, I'm getting late getting started with the training, and that's all right. We got a lot to cover. So, and I don't know how much time each of these classes will be. So we'll just kind of get as far as we can, and then you know, kind of save the rest for the next class. Now, there's kind of two parts to the understanding how to buy options. And that'll be what we'll focus on at first, and then we can get into selling, being an option seller. We're going to go over kind of the terminology and definitions in the early part. In fact, today I'm really only going to be able to get to the example. I was hoping to get half of these done, but I'll probably only get to the example of how an option works. That's probably all we'll have time for today. But we'll get into the definitions, and we'll learn about what a strike price is, expiration dates, and the bid-ask spread. And then the next portion of the training will get into option pricing. How are those prices determined? You know, what makes up the option price? We'll learn about intrinsic value and extrinsic value, and implied volatility is something you need to understand with options, and we'll get into some of that stuff. Now, I'm going to tell you up front, if you're brand new to option trading, it's going to be a little bit confusing at first, and there's a lot of new things. Just like anything you get into, that there's words you have to learn and get used to and know what they mean. But once you get it down, it's really easy. It's really simple, and don't get caught up in fully understanding exactly how the options are increasing or decreasing in value. Okay, that'll come, because as we talk about intrinsic value and extrinsic value and implied volatility, there's a lot of things that make up how that option is going up or down in value. The biggest thing that you need to understand with options is that you can never lose more. When you're an option buyer, you can never lose more than what you spend on buying that option, aside from any commission costs. But there's a lot of now commission-free trading out there that you don't even have to pay commission costs. And that you get tremendous leverage from options, and that's why we're participating in the option market. And another thing too is it allows you to trade stocks that you can't afford to buy the shares. And many of you aren't trading Google and Amazon because over $1,000 a share. But you can buy an option on not on Google and Amazon in this case, but because the options are kind of expensive too, and but a fraction of the cost of the stock. But you can get involved with option trading. Well, now with commission-free trading with as little as less than $100. Usually, I like it to be in about that $300 to $400 range to be able to have at least $300 to $400 you could put into an option trade. But it allows you to be able to get involved with trading and to have a chance to increase the value pretty quickly if you know what you're doing with that leverage of the option. Now, let's get into explaining how an option would work. And I'm gonna use a real estate example, how an option on a real estate property would work. The reason why I always do this, and by the way, it's been a while since I've taught. I usually have had recordings I've made a recording of trading options and going over option basics and terminology. I don't no longer have those recordings anymore, but I used to just have people watch those recordings because it became very repetitive and some of the stuff was really basic. And but so I'll if I pause a little bit, it's just I haven't taught this for a little while, so I'm trying to remember some of the examples and things I taught back in the day. But I like to use a real estate example because it's more tangible. Many of you have never traded an option before, but you've bought and sold a house before, and so you understand that process a little bit better. And then we'll transition, not today, but we'll transition that into how that would work in the stock market. So let me pull up a slide here that is my real estate example. Now, in this example, you guys are going to be the option sellers, and I'm going to be the option buyer, because that's what we're going to focus on first, is learning how to be an option buyer, why we want to be an option buyer. Now, let's say that you, as the seller, you own a home, and you want to sell that house for $100,000. Now, that may seem like a pretty inexpensive house, but it makes the math a little bit easier. So we're just going to go with that. So you have a house that you want to sell for $100,000. Okay. And I approach you and I say, you know what, I'm really interested in buying that house, and I'm really interested in that $100,000 price. However, I don't want to buy it right now. I want to buy it 6 months from now. So that would be out in September or something like that, or let's see, what would it be? August, right? I think I'm doing my math right there. So I want to buy it out in August. And so I want you to take the house off the market, agree to sell it to me for $100,000. And by the way, I also, I want the ability to be able to change my mind. I want the ability that if any time between now in August, I changed my mind. I want to be able to walk away from the deal and not have to buy the house. Well, how many of you are going to do that deal? How many are going to make that agreement? Well, hopefully none of you will, okay? Because that benefits him, benefits me in this case, because I'm going to be the option buyer here. It doesn't benefit you in any way. So you say, no, that's not a good deal for me. We got to find a way to make this a good deal for both of us. So I say, okay, I can't. You're not a pushover. So let's develop an option contract here. So we get out a piece of paper, and we're going to write down the terms of our agreement here. You're going to agree to sell me that house at a fixed price, at this price, this $100,000 price. And options have expiration dates. You can't have it, it's not going to be forever. So our expiration date is going to be 6 months. So on August, it'd be August 2nd, right? Today's the 2nd, March 2nd. So anytime between now and August 2nd, I can buy that house, and you guys have to sell it to me at this price. That's what we're agreeing on right here. But I'm going to pay you $5,000 for that contract, for that piece of paper, for that right. I have the right to buy that home for $100,000 anytime between now and August 2nd. And if I change my mind and I want to walk away, I can walk away. I'm not obligated to buy the house. However, I won't get that $5,000 back. I'm paying that $5,000 for this right to buy the house at $100,000 anytime between now and August 2nd. Now, why would I do this? What's my motivation for setting up this transaction? Well, because I know something that you guys don't, and I know that home prices are moving up quickly, and I believe this home is going to be more valuable in 6 months than it is right now. You can say, well, then why not just buy the house? Well, you're going to see why I'm doing it this way. So let's say 4 months from now, so we're into June, and that home, sure enough, just like I thought it would, is now worth $110,000. What are my choices here? What are my options here? Well, let's go with option A and option B, or choice A and choice B. I don't want to confuse everybody by using that term options here. So choice A, what could I do? Well, I could go up to you guys and say, you know what? I want to exercise this option. I want to buy that house for $100,000. And you say, okay, I have to do it. I'm obligated to do it. So you sell me the house for $100,000. I turn around and I flip it and I sell it for $110,000. Now, again, with all the transaction costs here, that wouldn't be a very good profit for real estate. You want to make a little bit more in a real estate transaction here. But again, I'm trying to keep the math and everything real simple. So we're not going to worry about any other fees involved with this. So I flip it for $110,000, sell it to somebody else for $110,000. How much should I make? I made $10,000 selling that house. Although, guess what? That's not what I made, because I had to buy that option for $5,000, right? So I profited $5,000. Or, because I got to come up with the capital to buy the house for $100,000, I'm making a $5,000 profit. So that ends up being a 5% return. Now, that's not bad for 4 months. Okay. It's not a bad return for 4 months. But that's one choice I could make. What's choice B here? Well, I own this piece of paper, this contract. I paid $5,000 for it. how much is that piece of paper worth? Well, if I have the right to buy the house for $100,000 and it currently has a market value of $110,000, that piece of paper would be worth at least $10,000, right? I could sell that contract to somebody else. You say, well, why would anyone else want to buy that contract for him? Well, maybe they think this house is going to go to $115,000. Between now and when they got too much left on the option contract, maybe they can, maybe they can make a little bit of money, or maybe they just want to be able to own that house for $100,000. They think it's going to go up over many years, and they have a chance to buy it at $100,000. The bottom line is that they're not going to, they're not. That's what the minimum value of that piece of paper would be. Is that difference between what the agreed upon price was for that house and what its market value is right now. So I turn around, I decide, oh, that's a good deal for me. I'm going to sell that option contract for $10,000. What was my profit on this transaction? It was $5,000, right? How much money did I have tied up to make that $5,000? Well, it only cost me $5,000 to buy that, or to buy that option contract. So I made 100% return. So that's why choice B is so much better. The dollar amount isn't going to change. How much I make is no different from choice A, but compared to the money I'm tying up, I'm spending a fraction of the cost, and so the percentage return is huge. See, I was able to control the appreciation of that house without ever owning the house. I owned the right to buy the house, but I didn't ever own the house. And that's what we're going to be doing in the options market. Is we're going to be able to benefit from the movement of the stock without ever owning the stock. Now, the key part of this, though, is we do have an expiration date. If this house stayed at $100,000 or went down in value, let's say it went down to $95,000 on August 2nd, I lost $5,000, right? Because I'm not gonna exercise that option and buy it for $100,000 when it's only worth $95,000. So I'm either going to lose the $5,000 if I exercised it, or I'm just going to lose it because I'm just not going to do anything. So there's the risk, but I can't lose any more than the $5,000. So this is an advantage of options as well. What if the housing market plummeted and this house is worth $85,000 on August 2nd? Well, I didn't lose. Let's make it 80,000 to make the math a little bit easier. I didn't lose $20,000. No, I only lost $5,000 because I can't lose more than what I paid for that contract, and I'm not obligated to buy the house. I don't have to buy the house. So you get great leverage, and you have limited risk. Now, I don't want to imply that option trading isn't risky, but really isn't any riskier than owning stocks. In fact, I always argue that it's less risky than stocks because you have a much smaller amount that you have a maximum amount. You know your maximum amount you can lose, and you know your maximum amount you can lose in a stock, but that could be huge, especially with how much money you're putting in. You know, if I'm buying $100 stock, you know, it could drop down to $20, and I could lose, you know, $80. Whereas if I had a $2 option, I can't lose more than that $2. All right, so why do we like options? We like options for the leverage. We like options for the control. We're able to control the movement of that stock without owning the stock. We don't have to own the stock. We have the right to, though. Anytime if I want to buy the stock and own the stock, I can exercise that option and own the stock. But typically, when you're an option buyer in the option market, you're not looking to exercise the option. Why? In fact, I've never exercised an option because there's really no reason for me to exercise an option. Because why would I exercise the option and make that 5% return when I could just sell the option and make that 100% return, or whatever that percentage ends up being, whatever that amount ends up being? So that's a key thing to remember. We are buying options to sell options. Now, they may end up being worthless because, like I said, if that house went down in value, I'm not going to exercise the option. I'm just going to lose that. I'm just going to lose the $5,000, but I'm not going to lose more than that. So we like it. We like the control. And I would even add in there risk management. I can't lose any more than what I put into that option. Purchasing 100 shares of a stock at $50 per share would cost you $5,000 plus commissions if you're paying commissions. On the other hand, if you were to purchase a call option on that stock for, let's say, $4 per share, you would effectively control those 100 shares of stock for only $400. And this is key, until the option expires, until that expiration date. But for a fraction of the cost, I can benefit in that stock going up. So if the stock goes up to $60, my option contract would go up too. Let's say it goes up $10, and that option contract is worth $14 now. You can see where this really starts to get exciting. Okay. Let's do another slide here, and then we'll wrap it up with this. So an option gives you the right to choose. An option gives you the right to buy or sell buy would be the call option, sell would be a put option, and we'll explain the differences actually next week, or on Thursday, excuse me. An option gives you the right to buy or sell a fixed amount of a given stock at a given price within a set time frame. Call options are purchased when you expect the stock price to go up. Put options are purchased when you expect the stock price to go down. I'm going to explain how put options work. Usually that gets confusing for a lot of people to understand how a put option is working. But put options are going to be one of your best friends. Even if you're just planning on being a stock trader and you're not going to want to do too much option trading, put options are going to be exciting for you for a number of ways. I've talked about how they allow you to make money when a stock goes down or the markets go down. And if you can learn to master that, then you can trade anytime, anywhere, all the time. If the market looks like it's going up, you're going to make money on it going up. If it looks like it's going to go down, it's looking like it could go down. How would you like to be able to profit from it moving down if it does start moving down? Or how do I protect my stock? I got all these stocks. Jerry just said the market's going down. How can I protect those? You can protect them with a put option where that put option will go up in value, and it might offset the losses in your stocks going down in value. That's what they call that a protective put. I'll talk about what protective puts are later on as well. But it's important that everyone learns option trading, even if you're not going to be an active option trader. There are so many ways you can manage your portfolio with options to reduce risk, to increase risk when you're dealing with a really strong trend, and you combine this with what we're doing, looking for high strength rank, 98 strength rank. So have you guys been following a lot of these picks that we do and seeing what the end result were? Not all of them worked out, but some of them made some pretty big moves, and they were exciting as stock trades. Imagine if you could have added a little bit more leverage and made a ton more on some of those moves. So put options are purchased when you expect the stock price to go down. Stock options are sold in contracts of 100 shares per contract. So each contract, remember in that real estate example, that'd be that piece of paper. So if I buy one contract of a call option, it controls 100 shares of the stock. Now, it doesn't mean it's going to be costing the same as 100 shares of the stock. It will control 100 shares of the stock. If I want to buy two contracts, I'll control 200 shares of the stock. Now, another question I get asked a lot when people are branded options, it says, well, you in that real estate example, it made sense. I was the option seller, you were the option buyer, but who is selling me these options? Who am I buying from? Well, it's like the same with stocks. Do you know who you're buying your stocks from? No, you're basically putting in the order at your broker. It could be, many times it is your broker, because your broker is many times the market maker. But it could be somebody that decided to sell their shares and they're selling them and you're buying them and they're matching those orders up, right? Same thing with the option market. I don't know who I'm buying the option from. And you can be an option seller. And if you are, I could be buying it from you. And that'll make a little more sense when we learn what being an option seller is. And we'll get into that during this topic over the next several weeks, next few weeks. Okay. And again, with if you can really just kind of keep it simple for now, if you don't fully understand how, just understand that a call option is going to go up in value if that stock goes up in value. A put option is going to go up in value when the stock goes down in value. And if you keep it that simple, you can make money with options. You don't need necessarily to understand how that's working. If you understand just that basic concept, you can make money with options. So keep it simple until you can grasp the whys and hows later on. Especially when we get into option pricing, it can get real confusing, and it doesn't need to be that confusing. All right, I'm going to wrap that up. I'm going to stop right there. Next, on Thursday, we're going to get more into what a call is, what a put is, and expiration date, things like that. We'll cover that on Thursday. All right, thanks everyone. Have a great week. We'll see you Thursday for the stock specific class. Bye now.